One of the things that makes options trading rather unique is the way options are priced. They are not priced the way that stocks or futures or currencies or cryptocurrencies are priced. When you trade a stock, for example, you're trading ABC stock and you buy the shares. Let's say the shares are priced right now at $100 a share. Well, if the stock price goes up above 100, you make money. If it goes down below 100, you lose money. It's obvious, right? It's obvious how that position, that long stock position that you currently hold, you understand whether you're up money or down money. It's very easy for you to mentally grasp what's going on. Options pricing is rather different because it is not one-dimensional. It's not about the price of the underlying asset going up and down. It's partially that, but it's more of a three-dimensional kind of thing. It's about the underlying price. It's also about time, and it's also about volatility. It's a three-pronged way to price that option. It's really kind of like playing 3D chess. In fact, I think the chess analogy is actually pretty good, especially if you've ever played chess on a timer, because now it's really getting closer to that options trading analogy, because when you're playing chess, it's about direction, right? It's about the moves. But if you're on a timer, it's also about getting the moves right in a certain time frame. That's kind of like your options trades. When you buy and sell options, you have to get the direction right within a certain time frame. But options have this third component, this volatility component, because your options are priced based on volatility. What is the expected move within that time frame you're trading? So when you're new to options trading, it can be rather confusing when you take a look at your trading platform. In my case, I use TASTYTRADE as my trading platform, and you look at some of your options and you check out the pricing and you're wondering, hey, why am I up money on this position, or why am I down money? Especially on things where you're wondering, for example, this calendar spread here. This is actually a diagonal spread, a call diagonal. I'm down rather big on this position. Why am I down big on this position? Well, I can tell you by looking at the three parts of the pricing, which are the direction, which is delta, the time, which is theta, and the volatility, which is vega. And I actually have all three Greeks here on my trading platform. This is delta, this is theta, and this is vega. Right now, the delta on this call diagonal is 20 long deltas. Now, I know when I put this on, I had, probably 50 or 60 long deltas originally when I first put the trade on. So I got the move wrong. Delta, direction, got it totally wrong, right? Because it's a bullish trade and it went the wrong direction. It went down in price rather than up in price, and the deltas, of course, got lower. That means I got direction wrong. That is why I'm down huge on the trade. Now, as far as theta, now this kind of trade is actually negative theta, so each and every day that passes hurts the trade a little bit, but just a little bit. Now, there's nothing I can really do about time passing. I can't stop time passing, but each day that passes, I'll lose, a few cents or whatever on the trade. And then on vega here, a call diagonal in this case is positive vega. So what we want is we want volatility to go up over the life of the trade. And in this case, I've been in the trade for a while. I did get a vol contraction, which hurt the trade originally. Then I got a little bit of an expansion recently, but now vol's coming back down. This is TASTYTRADE's IVR indicator here. But, I can look at these three components, the delta, the theta, the vega, which are direction, time, and volatility, and all three of them together paint a pretty bad picture for this trade, right? I know exactly why I'm down money on this trade. A great example of using the three Greeks to figure out why you're up or down money on a trade is strangles, because strangles sometimes are tough to figure out because they're not really directional at all. They have almost no directionality to them. For example, this strangle I've had on for 25 days now in General Motors. I've made a little money in it, but it hasn't done anything in that 25 days. I haven't made any money, haven't really lost any money. It's just a position. Now, why has this position not done much for me? Well, if I look at the deltas, when I put this strangle on, it probably was around 0 deltas. And if I look at the total deltas on the trade now, 4 short deltas. So delta-wise, it has gone nowhere. In the 25 days that this strangle has been on, the stock literally has gone nowhere, which should be great for a strangle. But you know what's bad for a strangle? Volatility going up in the underlying. And the market has been going down for 3 weeks, and volatility is sky high, and a strangle has a massive amount of negative vega, meaning we want vol to contract. Instead, what has volatility been doing? It's been expanding. It's been going up in a big way. So even though I got the direction right on the trade with this strangle, and I should be making money, I'm making a little money, but I'm not making as much. I should have already made 50% max profit and been out of this trade, but volatility was working against me. So that's why a trade that I'm sitting here thinking, man, this should have been a home run. The reason it's not a home run is because, again, options are that 3D chess, right? You've got direction, you've got time, and you've got volatility, and how those three work in conjunction with each other, that forms the options pricing. Now, I've done videos on each of the primary Greeks. I've done a video specifically on delta, I've done a video specifically on theta, and I've done a video specifically on vega. Go watch those videos if you don't know how the three main Greeks work. But essentially, I will give you a quick recap. If you're bullish in directional assumption, you have positive delta. If you're bearish in directional assumption, you have negative delta. If you're buying an option, so if you're putting on debit trades, typically you're going to have negative theta. Time is working against you. If you're short options primarily, like I am, I typically sell a lot more options than I buy, then I have positive theta. The passage of time is actually working for me. And finally, if you're long options, so if you're buying options, you have positive vega, meaning you want volatility to go up rather than down. If you're short options, you have negative vega, meaning you want volatility to go down rather than go up. And you need to know this because each and every trade you put on, you should quickly know in your mind based on that strategy whether you're long or short overall on the position as far as are you long options, short options, because that's going to tell you whether you're positive or negative theta and vega. And then the direction of the trade, is it bullish or bearish, is going to tell you whether you're positive or negative delta. And then, you know, that really tells you what you want that market to do. Because if you go into an options trade without knowing those Greeks, the delta, theta, and vega, when you put on the trade, you really don't know what you want that underlying asset to do. You don't know what the market should do for you to make money. You kind of ended up in a trade, but you don't really know how it's going to work out. You don't know what you're rooting for. So let's actually put on an example trade, and I'll go through this with you. We'll figure out exactly what we want on a trade. So I'm going to go to a ticker I don't have a position on. Let's go to Apple. I'm just going to place an example trade. We'll go to 60 days, and let's imagine that in Apple I want to let's do a ratio spread. Why don't we sell 2 of the 190 puts and buy the 195 put? This is a put ratio spread. And if I go to the curve and analysis tool, this is what a ratio spread looks like. Let's zoom in a little bit here. You can see we win to the upside. On the downside, we have a little bit of a hedge because we have an embedded put debit spread, right? It's really a combination trade. We have one naked short put, which is a bullish trade, and then an embedded put debit spread, which is a bearish trade. That's why if Apple goes down, we have the potential to actually make a little more money in this tent area right here. But if the stock falls too far, then that one naked short put that's part of the put ratio spread is going to get hurt pretty badly. So overall on the trade, we know we've got long deltas because just looking at the risk profile, you can tell this is a bullish trade. But because it's a combination, you've got the one short put, which is bullish in direction, and the put debit spread, which is bearish in direction. As a combination trade, how many long deltas do I have on this trade? Well, I can look down here and I can see I've got about 15 long deltas. So I'm long on this trade, but just a little long, right? Because it does, I've reduced my long deltas by having that embedded put debit spread that's part of the put ratio spread. Otherwise, if I would have just sold the 190 put by itself, I'd have probably 30 deltas rather than 15. So I do want Apple to go up, but it's not a crazy bullish position. If Apple goes down, I'm not hurt that bad on this position. Now, what about theta and vega? Well, remember, short options always have positive theta. Long options always have negative theta. I've got 2 short options versus 1 long, so I've got a little positive theta. In this case, I've got 6 theta. And with Vega, again, short options have negative Vega, long options have positive Vega. Since I've got 2 short options versus 1 long option, I've got negative Vega. In this case, my negative Vega is negative 20. So knowing all of that, what do I want to happen on this trade? Well, I've got positive deltas. So as far as direction, I want the stock to go up rather than down. That would help pricing. And then I've got positive theta. So the passage of time helps me. It doesn't hurt me. So each and every day that passes, I'm going to make a little money. And then as far as Vega, the volatility component of this options trade, I want volatility to go down over the life of the trade rather than go up. So knowing the delta, theta, and Vega, I know exactly what I want to happen in that trade. So if you're an options trader, especially if you're a new options trader, you really need to start paying attention to the Greeks. You need to know how the Greeks work. And if you want help in this, I actually wrote a book. I wrote this book called The Super Wheel Option Strategy, which is about my favorite option strategy, which is the wheel option strategy. In that book, I actually cover in pretty good detail the basics of the options Greeks, including delta, theta, and Vega. So check out that book. You'll find it on Amazon. You'll find a link to the book in the description below. Also, check out the DT Options Discord. I hold a live voice chat there each and every trading day. I share my trading platform. You guys get to see all of my opening and closing trades that morning, including rolling positions and defending losing positions and things like that. So check out the DT Options Discord. A link to that in the description below as well. Peace, guys.